Welcome, ladies and gentlemen. Today is October 22nd, Saturday. We're going to go over the custom index charts, and we're going to take a look at some of the cycle trend setups that are setting up with my custom cycle patterns. Okay, first things we're going to go over here is the Consumer Engagement Index. This is a monthly chart. This is one of the most important charts for me. I like to see how consumers are engaging. You can see we've had this nice little bounce since the June lows over here. We've seen this nice little bounce to the upside here, which means that consumers are more actively engaged in the economy. They are spending their money. They're engaging in travel. They're engaging in purchases. And this is likely on the hopes of a Fed pivot, which we have news now that the Fed is likely to potentially pivot. And I'll touch on that briefly as we go forward. But understand that as far as October goes, we've got a little bit of weakness here. We had a fairly strong September, and the past 3 months have been pretty strong. October right now is moderately weak, kind of sideways. We've got a hookup down here in stochastics, and we're getting a nice basing bottoming formation in RSI. We really need to see, as I mentioned to you, some real follow through to the upside, which I believe is going to come in a Christmas rally, but it may not extend. It's got to be really dependent on global resurgence of consumers and engagement, and almost a big pivot. So now, before I carry on, let me talk to you about what I think is going to happen with the Fed. I think the Fed is very aware that they have moved into very fragile condition. The news that I've been reading is the Fed has been raising rates while at the same time providing extensive quantitative measures to support the global economy and make sure that the wheels don't fall off the train in an excessive mode. To me, that means that the Fed is trying to break inflation while still provide fairly easy emergency quantitative strategy to make sure that the global banking system, global financial system, and global markets stay relatively healthy. I think they realize that they're moving interest rates excessively higher, up into the 4.5, 5.5 range, would be a disaster of epic proportions. And I believe they're going to move away from this mantra. And they're going to move towards a couple of months, possibly 6 to 12 months of very flexible strategy with regards to trying to keep the global banking system and financial systems and economies relatively stable while battling inflation. Inflation, in my opinion, is already coming down, and I'm going to show this to you in some of the other charts. But understand that the Fed's primary concern is with energy, food, and housing right now with regards to inflation. Energy needs to collapse, possibly down into the $60, $65 area for oil. Housing needs a good 20-25% decrease to wipe out the previous couple of years' pricing functions, possibly even more. And then, of course, food needs to settle. And it needs to settle in the sense that food prices need to really readjust to consumer demand. And it's going to happen no matter what. It may take 2 years, it may take 4 years, it may take 8 months, who knows? But all of these things are, in my opinion, primarily on the Fed's radar. And they're looking at it like, extreme aggressive pressure right now may break other things. Moderate, extended pressure, keeping rates elevated, not necessarily breaking anything, putting the screws, so to say, the longer term screws to inflation might be a smarter move than trying to break things. So we need to see again how consumers roll through this. Over the next couple of months, I believe consumer engagement is going to move up to this red level, possibly slightly above it. And remember, that could be a 20-25% Christmas rally in the U.S. markets, maybe more, if we carry into Q1 2023 back up into this high level across here. That could be about a 30, 35, maybe 40% rally in the U.S. markets. It may carry over into certain emerging markets and foreign funds as well as foreign currencies. We might see a 10, 15, 20% bounce in certain foreign currencies. as the US dollar kind of slides sideways. At least that's my expectations. I've done a couple of videos on YouTube about it just yesterday. Okay, next we have the large cap index sliding sideways, trying to find some support. Last week it was down near these lows over here in June. We're holding up again on a Fed pivot. We only have about a week and a half left to go before the end of October. I think we're going to basically end up fairly flat in October. I think next week is going to be somewhat volatile, trying to hammer out a bottom, maybe with a little bias to the upside given what happened on Friday with the Fed pivot, but it's not going to be a straight up rally. We're not at that mode yet, folks. We're looking at more of a kind of a moderate melt up through the end of the year with maybe a Christmas rally. The global asset index is holding up. Again, it was much, much weaker, really almost on the verge of a big breakdown last week. And it could still happen. Understand that, if the Fed were to, or the global central banks were to enter into any kind of a crisis collapse, which again could still happen. I had a talk with a friend of mine the other day, and what could cause global markets to really melt down excessively? Potentially a big infectious virus, new version of COVID, or some other virus. Number two, some sort of a global financial crisis event, maybe originating out of Africa or Europe or Asia. And number three, war, extensive war, potentially, nuclear war, but anything that would be global in nature. You understand, it would take something big to really collapse the markets here. Now, a financial crisis caused by central banks and what have you could be very, very critical to what's going on, which is why I think the Fed and global central banks are probably discussing and negotiating the way forward as to not break the global financial markets on the verge of war and virus setups going into the end of the year. And remember, that's really kind of my biggest concern here is not the stock markets in general. It's that somebody's going to make a mistake somewhere and push a button, and we're going to end up in some sort of a crisis mode. But again, finding some support, very deep bottoming. You can see we've had these same types of bottoms, 2011 and 12. We had these same types of bottoms, 2000 here, 13, late 14. And then we've got a very deep bottom back over here. It would not be so surprising to see this rotate back up into a reversion. Maybe not up to the highs, but up into the 40-50% range here in this box. That would prompt, again, about a 20-25% move in the large cap and global indexes across the world. Gold cycle index moving back lower. This is actually pretty good. We are going to get this rally phase, but it may still be, out in the 2025, 2026 area that this starts to really rally. These extensive bottoming formations here, and here, if you remember in this area, this was when gold skyrocketed from the 2009 area, the crisis here. This was the collapse in the markets. And then through this area, gold was skyrocketing through 2009, 10, 11, eventually peaked out over here, rolled over, and then moved sideways downward until the bottom in 2015, roughly. So we're looking at a sideways move in gold, looking to see the U.S. dollar move downward. We could see this extend out here another, possibly 12 to 18 months while gold continues to move higher and form a new base. I believe it's going to come with two things. Number one, I don't believe the dollar is going to move dramatically lower, but I think it's going to move down to the 108, 109 area and try to find support. That's going to reflect about a 10%, maybe 8% decrease in the dollar, which could prompt a 15 or so percent increase in foreign currencies. But it's enough to prompt gold to potentially move 15, 20, 25% higher on a weakening dollar and a shifting Fed. And this is what we've all been waiting for, is this shifting Fed. So pay attention, is that even though this may flatline down here near these lower levels, gold could begin a new melt up phase, which could put it back above 1960, 1970, maybe even to all-time highs over the next 6 or 7 months. So it's very, very key moment for gold right here as to what the Fed's going to do and how this is going to be interpreted as either fear or a shift into metals, or a shift into currencies, or some sort of reversion trade. Next, we have custom technology index. The technology index is holding up. I'm going to get to this FANGs index soon enough, but understand that this deep bottoming back here around 2013, 14, 15 areas is really proving to be very strong support. You can see right over here. It would not surprise me to see technology rally 20, 30, 40% from these areas. Understand that that would be up into this 45, 50 area here, but it's not going to be very surprising to see technology make a 20, 25% move on some sort of a reversion trade. And what this would be is shifting capital. Capital has been pulled out of the market. Traders have been holding on to cash. Traders have been waiting for something to buy into. I really think that the next move is going to be technology, innovation. As energy collapses, as the Fed pivots, I think you're going to see emerging markets, foreign ETFs, potentially currencies, technology, and really it's going to be those deeply undervalued sectors where you could see a 20, 25, 30% rally. In this particular case, this would be a move from roughly this 31 level where we're at down here up into this 44 to call it 48 level. And that's a big move, ladies and gentlemen. That's a 40 to 50% rally up into this area in technology, and it could happen across a number of sectors. So be aware that we're likely setting up into some sort of a base and bottom, and you need to be prepared to jump on this trend when it starts to confirm. U.S. to global market index. Okay, here's an example of why the U.S. market could rally about 20 to 30% up into this area here. And the foreign markets, this is the global market asset, custom smart cash index, it could really rally back up into these areas, back up into pre-COVID highs right over here. So we're at minus 1.84% compared to pre-2017 levels. I'm saying that we could get up into this plus 27, 28% range. That would be essentially from these lows about a 30 to 40% increase in the global markets. And in the U.S. market, from these lows down here around 41, 42, I'm saying we could get up here into the 73 to 80% area. That would be, if I'm doing the math right, that would be about a 45 to 50% increase from these low levels, maybe less. Let's do that math again. 30 to 40% increase in the U.S. market if this bottom holds. Now remember, we need to see this shifting take place. We need to see capital deployed. And where we're going to see capital deployed is going to be coming up here. I'll show you. The U.S. devaluation trend index, this is a good example of this basing bottoming formation setting up right here. We're still under weakness in October. We're not seeing any change in direction yet. So we're kind of trying to hammer out another bottom here, but we've got some real potential for a move back up into this area, which again would be a 25 to 35, maybe 40% recovery phase in the U.S. market. So it looks like we're trying to hammer out a bottom. You can see this hook down here. We've got very clear divergence in the stochastics. We've got clear a deepening bottoming formation here. It looks very likely that we have already reached or are starting to reach a bottom in the market. We'll just have to see what happens next. Custom volume ratio index is starting to show a little bit of accumulation. This is kind of nice to see after the weakness last week. I expect some real big accumulation next week, particularly if the Fed is likely to confirm the potential of a pivot or a weakening rate increase. Right now, the rate increase of 75 basis points is almost baked into the whole market right now. But if the Fed were to come out with a 50 basis point rate increase in November and then maybe a more moderate 25 or 50% rate increase in December, potentially the markets could shift dramatically, viewing this as a weakening of the Fed stance, a cautionary tale, kind of like the post-2008-9 collapse. When the Fed moved interest rates down, started the quantitative easing, what ended up happening is you saw a big rally in metals and silver and gold and platinum. You saw a lot of uncertainty and fear. but there was a lot of money poured into the market knowing that the Fed was actively engaging in protecting assets. We might be moving somewhat into that stance right now. So understand that we could be moving from a Fed quantitative tightening, we don't care, we're going to break inflation, to more of a, hey, we really do care, we can't let the wheels fall off the train, we're going to moderately try to break inflation while we try to support the global markets and make sure that everything doesn't fall apart. That could send gold and silver skyrocketing, and that could send some sort of a reversion trade in undervalued global assets, currencies, and U.S. stocks, particularly technology, the NASDAQ, innovation like the ARKK and ARKQ. We could see those rally maybe 30, 35, 40% or more if we get this resurgence of capital coming back into the markets. Okay, next, the commodity gold valuation. We're starting to see it move a little bit higher, basing off of this. This could be the resurgence trade, the reversion trade. It may end up back up here near this 2.3 level, kind of like up into these areas or these lows, maybe a little higher, back up into this area, which would be 3.5. We could see a nice solid little reversion trade carrying forward into Q1 2023. So get ready for it. We've got very deep rotation here. We've had an extended unwinding, almost 18 months of unwinding. It wouldn't be surprising, in my opinion, to see this rally back up into the 3s, maybe even the 4s, on some sort of a reversion trade, and then begin to weaken depending on what the markets do. Now remember, capital is going to look for undervalued assets. Okay, so there's a lot of undervalued assets right now. You've got foreign markets in chaos. You've got Japan with their currency, the Japanese yen, almost in chaos. You've got Europe almost in chaos. There's an article last week. Is it the right time to buy into Great Britain? Personally, maybe, but you have to be cautious right now. In another week or two, it might be a lot more evident that this is going to be a great opportunity if everything shifts. But right now, there's a lot of capital in the market. It's sitting in kind of a sideways mode. Nobody's really ready to jump into things, but it may be a good time to start dabbling into some of these undervalued assets, particularly foreign market ETFs, particularly a shifting currency, and in my opinion, gold and silver are still very, very poised for a good solid run. So be aware that this reversion trade that I've been warning about, remember, for about 2-3 months, is really starting to set up, just like I had warned. So now here we go into the next phase. The next phase will be capital deployment, trying to catch a nice 30, 40, 50% rally in certain areas. Then what will happen is capital will pull away and start reassessing what the next move is going to be. It may end up being back into U.S. assets again on a stronger U.S. dollar if the rest of the world continues to deflate a bit. Okay, the FANGs index called this one perfectly off of this deep low. We were looking for support in here. I kept warning down in this area. We could be looking at a double bottom. We could be looking at a deep kind of a washout low period, and now we get this reversal back to the upside. This could be the bottom setup, kind of like we had back over here. Remember, this was 2018, the very deep low. This was COVID. You know, buying down in this lower area, in this below this green line or near this green line, would have prompted very little risk, 3 or 4, maybe 5% risk to the downside, and had a big upside opportunity every time we got down in this area. And we just got down there last week. Okay, so now we're reaching this apex area. We could just blow right through this on some sort of a Christmas rally. We need to see it. It's not here yet. This is a good opportunity. I mean, I'm not going to tell you to do it, but if you wanted to dabble with a small portion into certain technology or Kathy Wood's ARC funds and possibly get into some early like TechL, TECL potential rally phases here, you may have a good opportunity to the upside over the next 2 or 3 or 4 months, particularly if we get this Christmas rally back up into this area and or this area. Remember, that's about a 40 or 50% rally right here. And it may happen by February, March, April if technology continues to perform. So understand that this is a very good scenario here, but I don't have any confirmation of this. It's up to you whether you want to kind of jump into this and dabble a little bit with some deep, low entry positions, but it may become very, very advantageous for you to do this. Now we have the metals index trying to really hammer out this double bottom. This really goes back into this COVID high area. And you can see back over in this area that we've got these highs, but it really comes into this pre-COVID range. So as you can see, we're in this pre-COVID range, and this is where this is really trying to hammer out this bottom right now for metals. I see the US dollar sliding sideways, moving from the 114, 115 area down into the 108, 109 area. And it's going to do so because foreign markets are going to possibly see a resurgence in value, and we're also going to see foreign currencies potentially see some sort of a resurgence in value as the Fed shifts and global central bank shifts. The pressure is going to come off. The dollar is still going to stay strong. U.S. assets are still going to stay strong, but the pressure off the global currencies and global markets is going to weaken by probably 20, 30, 40%, which is why we're likely to see some sort of a reversion trade to the upside. And of course, capital that's sitting on the sidelines is going to try to rush in and take advantage of these potential 20, 30, 40% rallies. But that means that there's also going to be a certain level of fear. And that fear is likely to drive gold and silver back up into this 420, 440 range by Q1 2023, potentially even higher. So we need to see how this holds up right now. And remember, this is very much like the end of the 2008 and 9 global financial crisis. Weakening Fed or shifting Fed, trying to provide some sort of a modicum of a soft landing, means that there's going to be an excess level of fear, and metals will likely benefit from that. Okay, the smart cash index, the global cash, this is the global market index, really trying to find support. Remember, this is very deep COVID low levels. So understand that we have gone through and we have eradicated all of the gains the last 2 years, all of the gains going back to 2015, 16. We're now down at these COVID low levels, which was a global collapse, a global economic shutdown, which is why this is a great example of why global markets are extremely undervalued and could move from these levels up into these 168, 170 levels, maybe up into these 180 levels, which would be the COVID highs again. So understand that if we were to see a shift, you could see a 50 to 60 point rally on this. That's a 45 to 55% rally in the global markets up into these areas right over here. And that's only a 50% reversion. That would basically mean that we're recovering back to 2018-19 levels and over into these highs, carry this green line over or this blue line. That means we're recovering back into these areas, and we're looking now for what the next phase of the global economy is going to be. So be aware, there's a very big chance that we're going to see some sort of reversion trade next. The U.S. stock market index, great basing and bottoming, nice rally last week. This is another great indication that we could see some sort of an upward move back into this 1100, maybe 1150 area. That arc, the Fibonacci price amplitude arc, or what I call the Tesla arc, has been very solid. This was the end of a destruction phase. We're starting to see a new breakout phase. I still think we could see a week or two of sideways trending into early November before we really get some sort of momentum to the upside. So be aware, the next rally phase is likely going to take us right up to this magenta level, maybe a little bit above it, this purple level, maybe a little bit above it, maybe back into this green channel here before we start to see some real weakness. That would be, ladies and gentlemen, from about 1,000, actually a little below, 970 to about 1,200. So that's going to be about a 250, so about a 25 to 30% rally phase in the markets. If we get above this level here, this past peak level, then we've established a new high. The new trend is bullish. We could, although, ladies and gentlemen, after reaching this peak area right up here, move into a bit of a sideways congestion as we move into January, February, where Q4 earnings will be coming out. So be aware, we're in a transitioning market. We don't know where the peak is going to be next. Could be much higher, but initially my target level is right around here, this 1200 area for the US, meaning it's going to rally up, maybe stall out a little bit, reach up here into this 1200 area, and then stall out a little bit into early 2023 before we determine what's next. What will likely come after that is some sort of a relief push, possibly a little bit higher in the US market, maybe getting up into this upper channel up here, 1270, 1280, while foreign markets deal with their own economic events, and we'll see how it plays out. But it's a little too early to kind of pick what's going to happen 8 months from now. Okay, the valuations index is holding up down here near these lows. This is telling us that we don't have any real opportunity yet to the upside. And so we're going to just let this see if this confirms. If we get a nice upward trend, we're going to see this break above the 62 level and try to move back up into the $70, $80 or point area. But long and short of it, ladies and gentlemen, we don't have any real accumulation in valuations yet. The volatility index, okay, this is where I was telling you we're going to likely see some sort of an upward move. So without getting into too much detail, it really boils down to anything above 8 and trending upward is moderately bullish. Anything below 6 or call it 5.5 and trending downward is bearish, is moderately strong to the bearish side. In fact, this is normally some sort of a breakdown event. Staying in between this 5.5 to 8 area is interpreted as basing, bottoming, or indecision. And it really kind of determines how we have higher highs, higher lows, or lower highs, lower lows in this area. You can see as we came off the COVID bottom here, I've drawn this box to show you that we kind of kept trying to test these channels moving higher. Then we shifted after this peak into a downward trend. We were really kind of lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. Now I think we're shifting back to the upside. I really believe that we're going to see a move to the upside, break above this purple channel, set up some sort of a new high, maybe roll back over in November, middle of November, maybe into early December, and then start a real cycle phase to the upside, and potentially getting back up here into this 11, 12, 13, 14 area. At that point, we may see some sort of an extended shift through 2023, maybe even moving into a bigger wave 5 rally that I've been telling you about for months and months and months. In fact, I'll try to show that to you if I get a chance here. But understand that this is going to become, if we see this rally phase start, we're going to see this move up above 8, 9, 10, really try to establish some sort of a peak move, kind of like we saw here. Rally up, establish some sort of a base, keep trying to bump up higher, while we see things like the Smart Cash Index and the FANGs Index here and the Commodity to Gold Index will start to move a little bit higher. Actually, we should be more so looking at this US to Global Valuations Index and this Custom Tech Index should all start to move higher while the Volatility Index here is rallying above 8, 9, 10. And then if that happens, we could be entering a new solid upward phase. Okay, so now lastly, I wanted to show you this. This is the custom cycle patterns. I have these detailed out. They're very, very interesting when you really think about it. So we have these formations here. These are the bars that I drew in TradingView based off of these patterns. And you can see it was a little off on this trending, but the call was that we were going to set up some early rotation here, which happened, then weakening trend, and then a bottom was going to set up right in this area and start to move higher and roll through it. So now I didn't draw the bars throughout this time frame, was really busy, but anyway, here we are going into the next week. We've got our big bottom here. So look here at the 13 pattern was crush 1013. Huge bottoming formation on this crush pattern. Then we have back over here, 928, a crush pattern, and then a temporary bottom, and then a breakaway So let's go to 928, 928 right here. A crush pattern, 928 right there. Okay, so that crush pattern is starting to become very, very critical. So we had one here, we had one here, and we look like we're going to get one on 1022, which is actually today, which is a weekend. But I want you to be aware that crush could indicate a big rally phase next week, trying to move away from this support level that I've drawn here. We could see it rally up like I'm drawing here and then move into the following week into November with another crush at 1028, which is right here on Friday. Could see a big rally phase up here on Friday if this takes place and if the market is trying to establish this deep, deep bottom. Now, next, what I wanted to try to show you was the, let's go here and try to show you how the global markets could, this is showing pressure in the global markets. We've seen this pressure set up all year long with weakening currency. If the pressure in the global markets and global currencies trends downward, meaning we're having lack of pressure, we could see the dollar move downward. We could see foreign currencies begin to rally a little bit, not having so much selling pressure on them. And we could see the dollar attempt to rally forward into now this is a weekly chart. So we could see the gold, try to move higher up into this 1850, 1990 range. And all it would take is a little bit of a shift in the dollar, a little bit of a shift in the global currencies to prompt a massive potential $300-400 rally phase, which would be a 20, 25, 30% rally phase in gold. So be aware that this is likely to happen, in my opinion. I think we're going to be looking at a fairly solid move to the upside in gold. I think we're going to see the dollar move back down to this 108, 107 level. And I think we're going to see global currencies shift higher by about 20, 25%. Maybe 15 to 25%, but it's going to be enough to shift the market into like an early rally phase. And then let's see, what else do I want to talk to you about? Well, let's come back over to crude and indicate here, this is what's going on with crude. We need to see crude oil and housing and energy, well, which is crude, and food start to decrease, to really drop inflation. Housing is going to do it. Housing is shifting right now. I'm going to go into that in the next bit, but housing is shifting downward quite aggressively. Expect a 20 to 25% decrease in house prices and a big decrease in housing activity. But understand that crude oil, as we move into December, we have potential for COVID infections. We have potential for crisis events in Europe. We have shifting global demand. I see crude oil as moving downward, down into this lower area here, about 60, 61, 62, maybe getting a little bit deeper into this 54, 55 area. But I see crude oil shifting downward as demand wanes. And this will carry likely into early Q1, Q2, 2023 before we start to find some sort of a bottom. So here I've highlighted Q4 2022. Here I've highlighted Q1 2023. I believe that shifting demand for oil, weakening food, weakening housing will prompt the Fed to reconsider aggressive rate increases over the next 4 to 6 months, and that may prompt a very strong rally in the SPY. Remember, target areas, this is the SPY, target areas really come in the ranges like this. We need to watch recent highs because high price levels, as they stand out, are called unique high price pivots in Fibonacci theory, and we really have to watch these levels going forward. These are our 3 unique pivots going forward. If a rally were to take place, likely once we get above this level here, 440, 428 roughly on the SPY, then we may enter a new rally phase that could extend well into 2023. So pay attention, folks. We're setting up some really big moves. All right, next we're going to go into the rotational modeling system and the real estate. and then we're going to go over the market setups. Follow me on Twitter, follow me on YouTube, visit MENT.com to go ahead and create your free account. Get ready, folks. The Christmas rally looks like it's setting up just like I've been talking about.